Hi, and welcome to FX Open's weekly market update. It could be another volatile one for the markets as traders brace themselves for some key central bank decisions. We've got some crucial US economic data and earnings from some of the world's biggest tech companies. So let's take a little look at what happened in the markets last week and what's on the calendar for this week. Well, let's talk about the rally of gold prices. Global gold prices have surged sharply in early 2026. Market participants are asking whether the gold market is broken or if it's a bubble. So as of the 29th of January, gold has broken multiple historical levels. Prices are above $5,400 per ounce. That's up around 25% year to date. This move reflects exceptionally strong demand during a period of elevated uncertainty. Now, according to the World Gold Council, global investment demand reached record levels in 2025. Momentum that has definitely carried over into 2026. Now, Goldman Sachs raised its December 2026 forecast to $5,400 per ounce from $4,900. Deutsche Bank sees upside potential towards $6,000 an ounce if the geopolitical shocks persist and the official sector buying intensifies. Societe Generale notes that its $5,000 year-end target has already been reached and now expects prices to approach the $6,000 per ounce level, warning that even this estimate may prove conservative due to the outsized impact of investment flows. So, what is driving the rally? Well, investor demand has accelerated over the past year or so. There's obviously some other factors as well. We've got the escalating geopolitical tensions around the globe. We've got Greenland, you've got Venezuela, you've got Iran, just to name a few. And we've also got President Donald Trump's renewed trade war, which is impacting pretty much every country around the globe. We have growing concerns over global government debt. Central banks continue to increase their gold reserves, reinforcing that structural demand. We have robust ETF inflows. And on top of that, supply constraints. While demand keeps rising, there is not enough supply. Other factors to consider are Fed rate cuts expected this year. And we've also got supportive APAC policies where, for example, last year, China allowed insurance companies to invest in gold, while India allowed pensions to invest in gold and silver ETFs. But what do all these factors tell us? Well, according to analysts, this rally is not viewed as a bubble, as it's driven by strong market fundamentals, not just the enthusiasm hopes of market participants. However, we should consider is that, of course, drivers can change. A stronger US dollar, tariff de-escalation, or geopolitical breakthroughs could pressure the prices that we're seeing. The size of the correction is, of course, unpredictable. Thus, new highs should be closely followed. Okay, so let's now take a look at the key events that could move the markets this week. And we start on the 3rd of February at 5:30 a.m. GMT +2 when the Reserve Bank of Australia announces its interest rate decision. Now, Australia stands out a little because whilst most major central banks are holding rates steady or preparing to cut them, Australia is widely expected to raise rates by 25 basis points, which could well mark its first hike since November 2023. Now, the main driver is, of course, our old friend inflation. Consumer prices rose 3.8% year on year in December. That was up from 3.4% the month before. Following the inflation report, the market now sees around a 75% probability of a rate hike. Now, even if this move is already priced in, short-term volatility cannot be ruled out. Now, the press conference is at 6:30 a.m. That's GMT +2. And that'd be especially important as policymakers may offer some clues about the future path of monetary policy. Any clearly hawkish signs could provide a little bit of support for the Aussie dollar. Later in the week, we'll also hear from the Bank of England. That's on the 5th of February. It's 2 p.m. GMT +2, and the Bank of England is going to announce its rate decision. Widely expected to keep rates unchanged, let's just get that out there. But intraday volatility is still quite likely. Alongside the rate decision, the Bank of England will publish its monetary policy report, of course, offering some updated economic analysis and inflation forecasts. Traders will obviously have a look at that quite seriously, but they'll also be watching the vote split within the MPC. A more dovish than expected distribution could put some pressure on the British pound. Okay, across the US now, and on the 6th of February at 3:30 p.m, that's again GMT +2, attention turns to the US labour market with the release of the Nonfarm payrolls and the unemployment rate. Now in December, the US economy added 50,000 jobs, down from a revised 56,000 in November and below expectations of 60,000. Now the unemployment rate did lower to 4.4%. That was down from 4.5%, which had been its highest level since October 2021. The US dollar had a bit of a mixed reaction to the data, initially turning lower. Now this time volatility could be even stronger, especially as the dollar has struggled throughout the last week or so. In fact, the US dollar index has broken below its downward channel and slipped under a key long-term support zone, a level that previously held twice in the second half of 2025. Now, this weakness makes the dollar particularly sensitive to the incoming economic data, so let's keep our ears and our eyes open. And finally, before we wrap up the macro picture, attention turns towards corporate earnings again. And this week, we've got Alphabet and Amazon set to report. Now, for Alphabet, investors will focus on Q4 advertising trends across Google Search and YouTube, as well as growth and margins at Google Cloud. Commentary on AI spending, monetization, and cost discipline will be key, as guidance could influence the broader tech sentiment across the market. Now, Amazon's results will highlight the holiday season sales, of course, operating margins and performance at Amazon Web Services. Updates on cloud demand, advertising growth, and efficiency measures will also be closely watched, given Amazon's heavy weighting across consumer and technology sectors. Last week, technology indices came under pressure after Microsoft's earnings showed slower cloud growth and delivered softer operating margin guidance. Investors a little bit concerned there about the near-term impact of artificial intelligence on profitability. Against this backdrop, earnings from Amazon and Alphabet could trigger some increased price volatility. So overall, the week is packed with high-impact economic, macro events, key central bank decisions, the US labour market data, and major tech earnings all have the potential to drive sharp moves across currencies, indices, and stocks. So as ever, your risk management techniques are going to be really, really important. Well, for real-time updates and deeper market insight, head over to the news and analysis section on the FX Open website. And as ever, we wish you luck with your trading in the week ahead. Bye for now.